Hey guys, welcome to the banking crisis for dummies by a dummy. I'm going to explain my thoughts on what's going on in the most easy to understand way that I possibly can for all the research that I've done. But remember, it's me explaining it, so don't get too excited because it won't be that in depth. But let's go. So, to start with, what we've seen recently in America are a lot of different regional banks start to collapse. Why is this? Well, a few different reasons. First off, really the main issue is confidence in the banking system, and we're going to get into the technicals of it after this. But the main reason is confidence in the banking system and the way that fear can spread in the new technological age. Now it's so easy to be able to spread a message, like one tweet on Twitter, and you could see something like Silicon Valley Bank had, I don't know what it was, but like say $48 billion worth of transactions or withdrawals in the space of like a day, whereas in the past, it would have taken a long time for a message to spread around a specific bank or a specific issue and then that to like accumulate into a bank run specifically. So the problem with the banks is that they have to only keep a certain amount of cash, like on hand, as collateral to be able to be withdrawn. So if you think banks have to run in a profitable manner because they have staff to pay and they have to make profits, etc. So when they get your money into the bank, they then invest that into a lot of different things. There are a lot of regulations around what they can and can't invest that into in order to stay like liquid and not to be too risky with your money, essentially. Silicon Valley was the first bank to go under. A big issue with all the banks in general is that they, in the COVID period, had a lot of extra deposits. All these deposits came in, and one of the things that they could put their money into, which counts as a really safe asset in the past, were treasury bonds. So when they had all these extra deposits coming into the bank and they weren't loaning out money to people because interest rates were so low and they weren't making much money on interest, they had to buy some assets that would give them a yield on the cash that they held. And if they held a treasury and they held it until basically that treasury could be redeemed, that could be marked as like as safe as any asset could be. So they could really put a lot of assets into treasuries, and when I say assets, I mean cash into treasuries, and that would be like a safe investment for them as a bank. They went to the Federal Reserve and said, okay, look, we've got all these extra deposits. We're thinking about putting them into treasuries. What are you going to do with interest rates over the next few years? And the Federal Reserve said back to them, okay, guys, well, we're not going to raise interest rates for a long time, maybe not ever, because we can't see any reason why we'd want to do that. So all these banks, specifically going on the Silicon Valley Bank example, said, okay, cool, we'll buy long duration treasuries, for example, like 10 years, and we'll hold them until maturity, because that counts as like as good as cash on our balance sheet, so it looks like we're not taking any risk, which has been fine in the past because you haven't been taking any risk because the US government can't default on their debt. But then what's happened is we had inflation because of the extra printed of cash, and also some supply chain issues, which is why I think we've got supply side inflation, or we had supply side inflation. But that's a completely different topic I don't want to get into, because that's a topic for another video. But so we had inflation, and the Fed were like, oh crap, like what the hell are we going to do because we've got inflation? So we're going to have to raise interest rates to cut down consumer spending, which essentially is their way of bringing down inflation. But by raising interest rates, essentially, long story short, treasury bonds then offer a better yield now than they did when all these banks had put all their money into treasury bonds. So any bank that bought treasury bonds basically before 2022 is actually now, rather than being an asset, is a liability on their balance sheet, because treasury bonds now yield a much higher return than they did before that, even though the Federal Reserve told them and promised them, look, these interest rates will never go up, so your treasury is going to be safe at this time. Meaning that all these banks holding treasury bonds were holding liabilities essentially, because if they were marked to market, meaning if they were going to be sold now, they would actually be technically at a loss. So all these really safe assets that were supposed to be as good as cash or like brilliant on the balance sheet, one of the real like safest things because the US government can't default, were now essentially a liability, meaning that they were an issue for the banks, like they're a problem. So when basically meaning the banks are insolvent, and up to a hell of a lot of money insolvent as well. So the next issue on top of that is when people started to realize this problem, they were like, oh crap, my bank's going to have no money. Look, they're making no profit. I need to get my money out of this bank because they aren't going to make any money and they're going to go bankrupt and I'm going to lose my money. When that started to happen, the Federal Reserve, or in this case actually the Treasury, Janet Yellen, came out and said, oh, we're not actually going to insure anyone's bank deposits over $250,000 unless you're in a bank that's deemed too big to fail. For example, like JP Morgan, I think Citibank and a few others are on that list. So that increased the capital flight from these banks. So everyone was like, oh shit, let me get my money out of these regional banks and put it into a more safe bank. And that's where you've seen this contagion, because people like First Republic, Signature Bank, Western Pacific, I think is the next one on the list, are starting to feel the same pressure. Like, regional banks have no promise of their assets being secure or their depositors' assets being secure over $250,000. So why would they not just run to a bank where they were secure? We're also seeing flights into money market funds and a few other things, but we're going to get into that a bit later on. But yeah, that's essentially the main issue, is that Treasuries, the Federal Reserve, basically fucked up the banks by saying these assets you won't get a better interest or you won't get a safer return anywhere else or a better return. But then they went back on their word to try and get a hold of inflation. So what are the solutions to this? Well, the medium-term solution is that they make it attractive for people to deposit into banks again. The first few things they probably have to do is print a shitload of money to say, okay, all the banks are going to be secure, otherwise they're going to continue this flight from regional banks and all the banks are going to continue to collapse. But what they essentially need to do, that's a little backstop that they're going to have to do, and that obviously includes, as I said, printing money. But what they need to do then is incentivize depositors to go back to banks, and to do that, they've got to give banks some sort of way of creating more or making it easy for depositors to want to go there and put their money there. Aside from the safety aspect, there's got to be some sort of return for investors who at the minute can make safer and better money outside of the banking system. So they need to create some sort of incentive for depositors to come back to the bank, and they're probably going to do that by bringing the yield curve back down to a rate where banks can be profitable. That's a short, medium-term solution. First off, as I said, they're going to have to print because they're going to have to bail out banks, and they are going to have to also secure all deposits over $250,000. They're the first obvious plays that they're going to have to make. A longer term problem that regional banks and banks in general also have, which is obviously a problem with the Fed, is that commercial real estate loans are up for renewal soon, and many people aren't returning back to the office. Even if, let's say, that's 20% of the population aren't going back to work in the office after C19, that's 20% of property that's basically going to be empty in terms of commercial real estate. And many regional banks and even larger banks as well hold a lot of this property on their balance sheet as an asset, which is again going to turn into a liability really quick when they've got no one paying the rent on this property. So that's another problem. So we saw First Republic get bailed out by some of the bigger banks like JP Morgan. A few of the banks put a bailout package towards them, given $30 billion. They spent that in 37 days. And then the Federal Reserve basically bought up the assets or took First Republic as a going concern and eventually sold it to JP Morgan. The deal was extremely favourable for JP Morgan, having something like $50 billion in like free loans. It made JP Morgan make $2 billion overnight. JP Morgan obviously bargained for a good deal, but also the reason that they're doing this is because they know that in the future these loans are going to come due on all the commercial property they had, and they had to make sure that they're not going to just take on a bank and take on all their losses and basically remove that from their bottom line. So that was the easiest explanation of that, in my opinion. Another tied issue that we have at the same time, actually, I'm going to talk about the Fed quickly. So the reason the Fed have continued to raise rates, which has been the issue here, is because of what I said in the first place, where people were panicking and leaving the banks. If the Fed then changed their policy on the raising of rates, it may lead into more panic and then a larger problem and a faster flee from the banks. Is essentially my opinion as to why they keep raising rates, because there's not really much other, like any other way to make sense of it. People say, oh yeah, to bring down inflation, because inflation is not coming down. Well, it is coming down if you actually look at the stats. And the Fed are basically just looking at lagging indicators. I believe that it's supply side inflation that we've definitely seen the top of, and it is on the way down trajectory. Next, I want to talk about the other issues that are going on. We've talked about commercial real estate. We've now talked about the issue that the Fed have got. So the Fed are going to have to reverse policy at some point, because banks can't make money, and until then they're just going to keep going bankrupt. And the next problem is the debt ceiling. People are getting worried about the debt ceiling being reached in America, and we could have something called a technical default, which I didn't even think was possible. I didn't even know was possible, and because of essentially politics. Obviously, it's all bloody politics. Technical default is one option. The other option is they just extend the debt ceiling. Both roads lead to more printing of money, because even if they have a technical default, they're going to print money after, because they're going to go into some sort of emergency measure and say, cool, we need to print. That's the only way we can pay off the debt. And if we don't get a technical default, they'll find some sort of debt restructuring program which includes printing, and then they will print money to pay off the debt, because it's the only way they can. They've got to keep devaluing the debt or adding to the debt in order to pay off the interest, because debt to GDP is over 100%, meaning that they essentially can't make enough money to even pay off the interest, let alone pay off the actual debt itself. So they have to print money. It's the only option, or go completely bankrupt and the whole world's financial system goes to zero. And I know a lot of people are calling for that, but it isn't really possible unless you want to start World War III. And I know there's a lot of conspiracists out there who say, yeah, World War III is coming. It may be at some point, but I don't think they're going to walk themselves into it, the US, and give up world reserve power, even for political means. So, and when I say political means, I mean arguing inside the country, Democrats versus Republicans, whatever. I personally don't believe that's going to happen. Maybe it's possible, but I think it's very unlikely. In worlds where banks continue to fail, and we may have a problem with debt ceiling and more lack of faith in the US government, Bitcoin thrives. As you've seen, the start of this year, banks failed, Bitcoin rallied 100%. Went from 100%. It went from 16,000 up to 30,000. It's like 27,000 now. Whether it's going to fluctuate in the short term, I don't know. But if we get towards a debt ceiling crisis, Bitcoin should rally again. People want to hold their own assets. They don't want to have an issue like they were in Cyprus or any other countries around the world with inflation or bail-ins. People want to custody their own assets and are looking for somewhere safe to store their wealth and store value. And that's just within the US. Outside of the US, crypto's growing at a big rate. We've got Hong Kong, who are going to be delivering crypto in June. It starts in June. They're going to be opening up for crypto trading to institutions and retail. We've got the Nasdaq opening up crypto custodian in Q2 of 2023. So there's a lot going on, essentially. And finally, my last few points. I know this is a bit of a choppy video, but I'm trying to keep it as short as possible. And my last few points and thoughts are about catalysts, potentially extra catalysts for the crypto industry. We're coming closer to the Bitcoin halvening, which, if you use TA and look at the past, that has seen crypto rally following this, or up into it and then following. You could say that this is based on M2 money supply around the world. And if you think that's true, then we're also leading into a period of more liquidity, which is also bullish for crypto. Another catalyst, which a lot of people may or may not like about this specifically, is Ripple and the XRP lawsuit is going to have some sort of summary judgment soon. If that's positive, it'll be great for the whole crypto space in general. Could get delayed and go to court, but you're seeing other huge corporations now like Coinbase fighting the SEC. It just brings more light to the fact that something's wrong with the politics in the US, especially around crypto, as the rest of the world seem to be embracing it. And finally, more pressure on the US around these things are both Ripple and Coinbase are setting up bases outside of the US, and Coinbase themselves have threatened to leave the US, the only publicly traded company, if you don't include MicroStrategy, that are essentially crypto related, looking to head outside of the US. Are they going to shoot themselves in the foot? Potentially, but I think that at some point they're going to realize they need to generate some sort of capital from some sort of tech and innovation, whether they embrace AI or crypto itself, I don't know, but they don't really want to be pushing innovation overseas, in my opinion. And that is going to be the end of my banking video and my thoughts. Essentially, I'm bullish crypto and bearish banks for the short term. And I think that's only going to increase as we see people fly to crypto in terms of store of value. And then we're probably going to see the utility of crypto come as well. We also may see the introduction of CBDCs and those sorts of things as well, like digital currency for the masses, but that's another video again. I hope you enjoyed, and I hope you understand why things are happening as they are. I've given it my best shot at trying to explain in the most layman terms that I personally understand, and I hope you guys understand too. If you enjoyed, please let me know, and if you've got any questions, please put them in the comments and share with your friends. Peace up, A-Town down, as usual.